What is up, guys? Today we're going to explain how insurance companies work. We will cover how insurance policies are created, how the cost of damage is determined, and how insurance companies make a profit. First, let's explain how the policies are created. Insurance policies cover specific assets, and there are many policies to choose from, such as home, auto, motorcycle, boat, health, and many more. Flood, earthquake, renters, mortgage, life, and professional liability, to name a few additional policies. Policies are created by actuaries, which are mathematicians that specialize in measuring risk and uncertainty. Actuaries assemble and analyze numerous variables that the policyholder gives to the insurance company. There are many variables that affect risk, such as location, lifestyle, gender, experience, history, marital status, credit score, neighborhood crime, number of children, occupation, and along with many additional variables. Using mathematical equations, actuaries help design and price insurance policies. Insurance companies then understand how much they should charge a policyholder for the liability they are covering. Determining the risk accurately is critical. If an actuary underestimates the total risk for a policyholder, then the insurance company could pay out more than they expected, and if repeated regularly, the company could go bankrupt. On the other hand, if an actuary overestimates the risk, the policyholder's premium will be overpriced. This can develop an unsatisfactory relationship with the policyholders. Realizing their policy is overpriced, they may decide to switch to a different insurance company. Next, let's explain damage cost. When an actual incident occurs, the policyholder will notify the insurance company, in which the insurance company will have a claims adjuster assess the damage of the claim. A claims adjuster is an appraiser, and they assess the actual dollar amount that needs to be paid out to fix the damage. The claims adjuster will send the estimated damage report to the insurance company, and the insurance company will pay the policyholder the amount to repair the asset back to the original state it was in before the accident happened. Adjusters can investigate the cause by interviewing witnesses, consulting with police, along with other investigating techniques. For example, if a policyholder intentionally set fire to their house, then the insurance company would argue that they are not liable to pay the claim. Next, let's explain how insurance companies make a profit. Insurance companies provide policies to policyholders, which cover risk. In return for holding this risk, the policyholders pay a premium. Let's say they collect $100 from the policyholders. Then when a policyholder reports a claim, the insurance company will pay the claim. Let's say the claim is for $60. That leaves $40 left over. The money is used to pay the business's operating costs, such as employee salaries and utilities. Then the remaining amount is the retained earnings. The company can invest the retained earnings into investments, such as stocks and bonds, land, and other investments. These investments earn revenue, and the money goes back into the company. The company can use the earnings to pay off more claims. They can also use it to pay off operating costs, or even give employees a bonus, hire more employees, or upgrade equipment. The company can also use the money they earn from investing to reinvest back into other investments. This cycle continues where the policyholders pay premiums that cover their claims. Then the remaining can go towards operating expenses, then to investments. However, the insurance company can suffer a loss due to a high number of claims in a year. These can leave no room for investments or cause a layoff. For example, a hurricane can wipe out hundreds of houses, creating a number of claims that need to be paid out. That is going to conclude today's video, but before we go, let's do a quick recap explaining how insurance companies work. To create a policy, insurance companies hire actuaries, which are mathematicians that calculate the risk. This helps determine the amount an insurance company will charge a policyholder for accepting the potential liability. Next is damage cost. To calculate the damage, insurance companies send out claims adjusters. Claim adjusters determine how much the policyholder needs to fix the damage. The goal is to provide enough money to the policyholder to fix the damage, but not an excessive amount, where the asset is in better condition than it was before the accident occurred. A little side note, claims adjusters don't actually have to go to the physical location. Policyholders can send in photos of the damage. And lastly, insurance profits. Insurance companies can use the retained earnings to invest. These investments can earn the company additional revenue, which can be put back into the business, helping to pay for extra claims, paying employees, and reinvesting the money back into more investments. Also, I would like to note the other video categories that might interest you in this channel. Other topics include insurance, law, finance, accounting, and business. Thanks again for watching, guys, and I'll catch you in the next one.